Hey guys, I'm Santosh and I'm back with another interesting topic today. So today in this video I'm going to talk about one of the most safest investment strategy which one can follow to make returns beating inflation, and also the conservative investments like FDs and RDs. You can expect easily around 10% every year, and that too in a safest possible way. So for those who want to make some real good money, and who can hold it for a long period of time, then it is a great opportunity to create wealth. And so in this investment strategy, we'll rely on ETFs, which is nothing but exchange traded fund. So for those who don't know what ETF means, it is basically a fund managed by fund house, like any asset management company, like SBI, Mirae Asset, or Nippon India. So whatever it matters, the fund house initiates a ETF. And generally ETFs are based on either indexes like Nifty 50 or Sensex, especially in India. And also some of the ETFs are basically uh, based on the sectors like metals, banks. Yeah, so what exactly they are trying to do? uh, See, we people, we always know that Nifty 50 or Sensex, whatever it is always keeps going in upward direction, although it may go down for some time, or it might consolidate for some period of time. But at the end of the day, after few days, if you look at the graph, then you'll definitely see this upward momentum. Let me open Nifty 50 chart so that it'll make you guys clear. Yeah, so this is Nifty 50 chart, and I opened it in daily time frame. So uh, if you look at the long term view of this Nifty 50, then you can clearly see that although it is in some time it is going in upward direction very fast, and for some period of time it is going down, then going up, and then going down, and then going up. But if you look at over a period of time, it is always in upward direction, and sometimes it gives fantastic returns like what we have seen post corona. But sometimes it keeps consolidating, so it will give merely some decent return. Now, so what fund houses, asset management companies will do is, uh, especially when they want to initiate an ETF based on an index, then let's say they want to start an ETF on Nifty 50. Now, whatever the amount we invest in ETF, they will buy the same proportion of securities consisting in Nifty 50 from the exchange. And these are the basket of securities, and they will derive small units. Like for example, if you want to buy all the Nifty 50 stocks, will you be able to buy as a retail investor? I don't think so, because adding up all the stock prices from Nifty 50, it could it could be in uh, thousands or lakhs or whatever it is. But a small retail investor, they can never buy all the Nifty 50 stocks. But what these fund houses will do, they will derive smaller units. Let's say the total amount is 1 lakh rupees to buy all the Nifty 50 stocks. Now these fund houses you know will create, let's say, for example, I'm saying, let's say they want to derive 100 units from this 1 lakh. So what they'll do, they will divide into 100 smaller units, so that each unit will cost you 1000 rupees, so that any retail investor can go and buy 1 unit of this ETF, which means even that 1 unit is reflecting that index. So if you are investing 1000 in this ETF, which means you are investing on index. Now when Nifty 50 moves up, then your 1000 will move up. When Nifty 50 moves down, then your 1000 will move down. And when it stays consolidating, then your 1000 will remain almost the same. Now we have understood one thing, that over a period of time Nifty 50 will always go in upward direction. Now as a retail investor, you have invested in an ETF, so which means you are basically investing on index. So obviously over a period of time you will get that positive return only. Now let's look at some of the ETFs, uh, you know basically available in Zerodha. And one more major difference that I forgot to mention is, although it is a kind of mutual fund, you know, uh, managed by uh, the fund house, but remember, this is the these are considered as passive mutual fund, because uh, these ETFs are basically relying on index. So there is no need for active managing by fund managers. uh, you know it's not needed, because it has, if the ETF says that it is based on Nifty 50, then obviously it should hold all the securities from Nifty 50, no matter what wrong with one or two companies from Nifty 50. It has to hold all the securities from Nifty 50. Now so as there is no need for active managing, so generally the expense ratio for ETFs will be comparatively low uh, with respect to the regular mutual funds, where the fund managers will actively manage the fund by modifying the proportions, and also by changing the weights for the companies they hold in that basket. Now generally for ETFs, the expense ratio will always be below 1.5%. But choose the ETF which is having its expense ratio uh, below 1%, so that it won't cost you much. But generally when you go for actively managed mutual funds, the regular mutual funds, then you'll probably end up paying a little more expense ratio, because it is actually actively managed by the fund managers. Now so we have understood the expense ratio and the nature of securities that it is holding, and something about ETF, right? But the one more important thing is that the word itself says that it is exchange traded fund. It is not only you can you can go and buy a mutual fund only with the mutual fund asset management company, but here ETFs can be bought and sold even on exchanges, which means we have that flexibility of liquidating that ETFs that we are holding, or if you want to buy it immediately right away, then you can directly place a buy order in the in your trading terminal, and you can quickly buy that ETFs, and which will be credited to your demat account in T plus 2 days. But when you want to buy it from asset management companies, then there will be this concept called creation size, which is basically high when you want to buy it from asset management companies. We'll discuss this in short while. So we have understood where can we buy this ETF, which is you know we can buy it from both exchanges, that means using trading terminals we can buy it from exchange, or we can buy it from mutual funds. And uh, and what is the creation size? So to understand what creation size means, let me open the famous uh, ETF, which is Nippon India Nifty Bees. Yes. So if you want to invest on one particular ETF, which is based on Nifty 50 stocks, then you can definitely try out Nifty Bees, which is getting its own popularity with time. Its craze is getting higher and higher every day. Now, if you look at this past performance of this Nifty Bees, then you can clearly see that for 1 year it has given 25%, 3 years 18%, 17%, 16%, which means at the very basic level you can definitely expect 10% at least, which is what I said earlier. So you can make even more. So who knows, if you are getting 20% every year, then in the next 5 years you are going to make more than double your capital, right? So this is definitely considered to be a safe strategy, because you are basically investing on index, not on a particular stock. So you are diversifying your investment, which means your risk level is nullified. So obviously, when everything is going right or something is going wrong with some companies, then the other good companies will balance the negative happening with the wrong companies, which means your returns are always expected to be a positive one. So obviously when you hold it for a long period of time, you'll be able to make some decent return. And yes, so we have talked about the creation size, right? Yes, so here if you look at this, um, uh, as I said earlier, you can buy it from exchange, stock exchange, or directly with the mutual fund. But see here, the if you want to buy it from mutual fund, you have to buy it in multiples of 50,000 units. So you cannot go and buy 1 unit of this ETF, and the current price, latest NAV of this ETF is 189 rupees 2 pies. But you cannot go and ask for 1 unit of this ETF with mutual fund. You cannot do that. You have to buy 50,000 units of this ETF when you want to buy directly with mutual funds. Or if you want to buy with stock exchanges, then you can directly buy 1 unit of this ETF. So people prefer buying it from exchanges, uh, especially for those who are having less capital. They'll prefer buying it from um, exchanges, where they can buy 1 unit of this ETF. And as it is not an actively managed fund, although it has fund manager, but remember, see, basically all the indexed funds are passively managed, which means they are very rarely managed. Situation will come very rare, so that the fund manager needs to put in his effort to manage the fund. So other than that, it is considered to be a passively managed fund, so which is why we are seeing the entry load and exit load as null. So as we are investing on equity, so the risk will show high, but remember, we are investing on index, not on a particular stock. So you're basically diversifying and reducing the risk here. So that's about the basic details about ETFs. And about my investment strategy for this, for the safest possible way. Just look for nifty ETFs in your trading terminals, and you'll get a list of ETFs trading on the trading terminals, but I prefer nifty Bs among the others. So let me open that. Yes, now if you look at this chart, it is, it looks very close to that of Nifty 50, right? Let me compare it. See, it is almost close to that of Nifty 50, right? Now, see, it is almost close to that of Nifty 50, which means you're basically getting the returns similar to that of Nifty 50. So it is highly unlikely for you to lose your money unless some drastic things like corona or some other big corruption things happen, or some issues with political or defense related issues, or anything which is very bad news, so that only then Nifty can fall very much. Until then you'll keep getting that positive return. And as it is an exchange traded fund, you can buy 1 unit of Nifty piece, and you can sell it whenever you want during the market hours. Right away when you thought Nifty is going to go down, then you can directly place the sell order, and you can get your money back. So in this case, Nifty Bees is one such ETF which is based on Nifty 50 index. So I'll explain you how to buy and how to sell, but before that we have to understand this: who controls liquidity at exchange. Now see, one thing we need to understand is when you look at the market depth for Nifty Bs, let me open NSE India Nifty Bs. Now okay, as it is, the market is closed, so we are not seeing the exact buy and sell orders, but generally what happens is for ETFs which are not very popular, their liquidity will be quite low compared to the other popular ETFs in the market. Now you have to check what is the volume traded for the ETF we are choosing. See, it is 3.2 crore, right? Yes. No, 32 lakhs. It is 32 lakhs 76,000 change. So a total of 32 lakhs 76,311 units were exchanged in the previous day. Now see, in whichever ETF the volume is almost the same every day, especially in a decent number, and also if an ETF is continuing its journey with increasing volume, then obviously it is getting its popularity in the market. So you can definitely opt out for that. And also look for the buy and ask spread, so that you'll understand the liquidity present in this ETF, so you can buy and sell it at any time you want. Now see, whatever the price that we are seeing here, 189 rupees 45 pies, uh, we'll go and look on EMC's website, which is yes, this one. Now 189.20, the latest NAV present, it is 189.45 on the stock exchange. So we are seeing a slight difference here, right? And this is because the demand and supply that we see generally in exchanges. So basically, when the demand is more, then obviously we'll see a higher price, and when the supply is more, then we'll see a lower price. So there will be slight difference between the actual NAV of the Nifty Bs that we are talking about and the price that is trading on the trading terminal. So it is better to look for the indicative NAV price, which will be updated every 15 seconds on the AMC website. So you can check this price before you place a buy order in your trading terminal, so that you won't pay additional price for the same stuff that you are buying it from mutual fund. So we want to buy it at the same cost, right? We don't want to pay any kind of premium here. So try to place the buy order at the same indicative price shown on the mutual funds website, so that you won't pay much higher price. And when this difference gets increased or decreased by a bigger amounts, now there should be someone who should balance this, right? Otherwise what will happen, it keeps deviating from the index, and the returns will be different compared to that of index. That will take you out of the objective what this fund is intended to do, right? We are investing in this ETF because we want to get the returns that we are expecting it from the index, and we don't want to see a different kind of returns when we are investing on index based ETFs. So what AMCs will do, they'll assign few people who are called as authorized persons or market making people, so that when the uh, let's say there on exchange we are seeing a slightly lower price compared to that of the indicative price shown on AMC website, then these people will buy the securities of Nifty 50 from the open market, and they'll exchange it with the AMCs for the ETF units, and they'll keep buying or selling based on the demand and supply uh, that we are seeing on the trading terminal. Now when the supply is more and demand is less, so these people will come and they'll place the buy order, and when demand is high and supply is low, then these people will come and place the sell order. Now why are they doing this? This will do two things. One is it will provide liquidity for all the retailers, and second reason is they will make sure that it is not deviating from the actual index movement. When the index is going in positive direction, it shouldn't go in the negative direction, right? That's Then we cannot say it is index based ETF. Only when the index is positive, the ETF should be positive. Only when index is negative, then ETF should be negative. So for that reason, these market making people, they'll keep placing buy and sell orders to make sure that it is stable with respect to the index movement, so that people are not surprised with the movement in this particular ETF. Yeah, so when you are able to make around 25%, 18%, 17% you know return over a period of time, then it is absolutely worthless to invest in FDs, RDs, or any conservative investment, because you are investing on index, which means you are investing on the big names of India. So your money will be highly secured, and this is a great opportunity, but because ETFs didn't get that much popularity uh, in the market, so people are still learning about ETFs and what they actually do. So try considering investing in ETF, and but remember, the most important thing is, don't just go directly and invest in ETF whenever you want. Just wait for the moment, and then you can invest. See, uh, only when the market falls, when Nifty 50 falls by more than 1% or 2%, or 3% or 4% in a week, or 5% in a month, then it is the right time. Go and put your lump sum amount on Nifty. And this can be also used to make monthly income for people, for smart investors will follow this strategy, because uh, they want to make 2%, 3%, or 5% return every month. So what they'll do is, when Nifty falls by 2% or 3% in a week or in 10 days, then they'll go directly and buy some Nifty Bs, so that when the market picks up and recovers, then they'll sell and keep the profit. So these are two things which people do. You can either generate monthly income using Nifty Bs, or you can generate wealth over a period of time using Nifty Bs. So this is the safest thing which I found, uh, which will be beneficial for people who will hold for a long period of time. Then they'll definitely see a good positive return, outperforming other conservative investment instruments available in the market. So do your own analysis on Nifty Bs and ETFs, and also on the AMCs that you want to choose, and talk to your financial advisor, and take an informed decision. So that's about it, guys. I hope you all like the video, and if you haven't subscribed to my channel yet, then please hit the subscribe button, and also the bell icons, if you want to receive regular updates from my channel. And we'll meet up again next time with another interesting topic. So until then, see you. Bye bye.